What's up, everybody? Today, I'm going to talk to you about two stocks that are positions in my portfolio that I have been adding to. I've been buying more of these stocks as they've gone down in price. They're both decent quality companies trading for very cheap multiples. I think they're offering excellent risk reward today. As always, nothing in this video is advice to buy or sell any of these stocks. I just give you my opinion and I tell you what I'm doing with my money. So if you get value out of the video, subscribe to the channel. Now, let's get into it. And before we talk about the individual stocks, I just want to talk about the market as a whole and value investing in general. The market is down over the past month, about 5% from its all-time high. I imagine that most investors are down over the past month as well. I am down over the past month, and first let me tell you, a 5% drop in the market is really nothing. Market declines and pullbacks can be much more dramatic than this. Nevertheless, for many investors, when they see their portfolio decline, even 5%, I think it causes a lot of fear. That can lead to investors thinking less rationally, making poor investment decisions, and in times like this, it really helps to just know what you own. Now, this is not one of the two stocks I'm going to talk about today, but just to give an example, it's a company I own in my portfolio that I've mentioned before, StoneCo. While the stock has still been almost a double for me, in fact, a month ago, it was more than a double for me. Over the past month, it's down about 20%. Now, if you don't know what you own, if you don't follow the company, if you don't read their quarterly reports, then maybe when the stock drops, you sell out, maybe you panic. I don't know. But for me, my thoughts following the company, when I see this, I see a stock that now today is trading for, roughly 8 times earnings, that is growing double-ish digits on the top line. Yes, there's currency risk. This is a Brazilian company. There is always risk, but this is a stock that is decent quality. I think it's decently run, and it's trading for a single-digit multiple while still growing quite strongly. When a company like this drops 20%, I'm fine just holding my position. One of the fundamental reasons why value investing works is that the price of a stock, the price of businesses is often way more volatile. It moves way more dramatically than the value of the underlying business. Just looking over the past 5 years, this company traded for over $90 a share and for under $9 a share. So the price here has fluctuated by more than a factor of 10. Now, the price movements here have probably been more dramatic than most stocks, but still, when you look at any individual stocks, the price moves way more dramatically than some rational view of the underlying value of the business. This volatility in stock prices, it's not a bug, it's a feature. I sometimes hear people refer to a stock where the price has crashed and they feel that the price is way lower than the intrinsic value. I sometimes hear people refer to those stocks as broken stocks. This is not a broken stock. This is how stocks work. Price and your opinion of underlying value don't always move together. This is what gives us opportunities to buy stocks at very cheap valuations. And this brings me to the first stock I'm going to talk about. And I know a lot of people have some pretty intense feelings about this company, but it's PayPal. This is definitely a stock I've heard people refer to as a broken stock. And let me tell you, it's not broken. This is how stocks work. If price didn't occasionally become very divorced from underlying value, then we wouldn't have opportunities in the market like this. I think there are many investors out there who maybe got into investing or looking at stocks in the COVID era. So you look at something like PayPal and it's been down and it feels like it's just been stuck in this range for, several years now. And that just feels like forever. It feels like PayPal has gone nowhere for the longest time. In the grand scheme of things, this really isn't that long. To give you something to compare it to, I'm going to pull up, one of the most popular stocks in the entire market. We're looking at Microsoft. And if we look out, if we pull this back a bit, Microsoft is so high now that back here, you can't even really see the ups and downs. But in the .com crash, Microsoft went down more than 50%. It was easily cut more than in half. So split adjusted in 99, it was, roughly $60 a share. And then it dropped all the way down to the low 20s. And after it dropped down, I'm not even using its peak price. After it dropped, do you know how long it stayed down here? I mean, for over a decade, this company basically didn't go anywhere. Meanwhile, the underlying business was improving. They were dominant in so many areas. It was a cash flow machine. And in 2013, this market leader cash flow machine that was growing was trading for roughly an 11 times multiple. Was Microsoft a broken stock? I would say no. This is simply how stocks are. Price can become very disconnected from value. By the way, maybe someone heard I was making a video about PayPal because since we started recording, the stock is up 1.5%, but that's really not here nor there. PayPal could stay roughly at this price for many more years. I have no clue what's going to happen to PayPal. I simply buy a stock when I think that I'm being offered excellent risk reward. And that's what I thought a couple years ago when I bought PayPal. PayPal, for me, this position, I was up 60 to 70% on my holding in PayPal. And now today, I'm up about 7%-ish on my holding. But yesterday, I added more to PayPal. Now, I don't know if PayPal will go up or go down, but I think the risk reward on PayPal is even better today than when I was looking at it a couple years ago. The company had really quite a good earnings report just a few weeks ago. Top line growth is re-accelerating. Venmo growth was above my expectations. Total payment volume on Venmo is up 14%. Anecdotally, pretty much everyone I know has Venmo and uses it consistently. Margins have been improving while that top line growth has been picking up, and they say PayPal is a stronger company today, and I agree with them. Growth is not explosive, but this is not a dead company by any stretch. On top of that, partnering with Perplexity, ChatGPT to integrate a PayPal wallet directly into an LLM, I don't know if that's going to translate meaningfully to the bottom line, but if it doesn't, PayPal is still a growing company that looks strong, and if it does, then PayPal is just meaningfully undervalued. Between ads, crypto, and agentic, I'm not really counting on any one of these areas to be a game changer for PayPal. If it is, I will be happily surprised, but my base case for PayPal, I'm just assuming margins stay where they are and the revenue grows 6% every year for the next 5 years. I'm not really giving them credit for any new big growth stream coming from anywhere in the future. And yeah, I'm giving them a 14 times multiple, which is a bit of multiple expansion, but I think it's warranted for a company like this. And in this scenario, I'm looking at more than a 20% annualized return on this stock every year for 5 years. Now, there are recession concerns, and PayPal has signaled that consumer spending might slow. So, in my bear case, I'm assuming essentially no real growth on the top line. Top line, this is essentially in line with inflation, 3% growth. And margins, I'm assuming margins contract, and I'm only giving them a 10 times multiple. And even in this scenario, I'm looking at an 8% annualized return, which is better actually than what I would forecast for the total market over 5 years. Obviously, if PayPal outperforms, we could win big, but I'm not even focused on that case. I think my base case is reasonable, and I think the risk reward is excellent. So yes, I chose to add to my holding in PayPal. Now, PayPal may continue to be range-bound and trade sideways for several more years. I have absolutely no clue. But I've seen some people say that, you shouldn't own PayPal because the opportunity cost is too high. And that's something I just want to talk about for a moment because I think it's a really silly way to think about stocks. Everything is clear when you look with hindsight. Sitting here in November 2025, I can obviously tell what the best investments would have been over the past 2 years. And clearly, it wasn't PayPal. But we don't get to know that at the time that we make an investment. I don't know if PayPal will trade sideways for the next few years. I just think the risk reward is good. A stock like this could do nothing for another year and then double over a month. I don't know. Looking back now and saying that, hey, PayPal's a bad investment because of opportunity cost is really missing the point. We don't have the benefit of hindsight. If you're watching this video in 2027, you might have a better sense of whether this was a good decision or a bad decision on my part. Over the long term, with a portfolio of stocks, if we focus on excellent risk reward, we're going to do okay. Now, the second stock I want to talk about that I've been buying more of, I feel like I've been writing almost every week in Discord how I've bought a few more shares of this company, and it's Molina. While again, the stock market is only 5% off of its all-time highs, there are certain sectors that have been hit extremely hard. Healthcare is a sector we've talked a ton about. Pretty much all the holdings that we bought, Centene, Elevance, UNH, they're all up actually from the prices that we were entering at. The one exception is Molina. Molina is a stock we first talked about when I think it was trading about 175. I sold some puts on it that didn't get filled. The price moved away from me. I thought, okay, that's fine. I don't need to own Molina. But, then the price came back to us. I bought around 160 and I've been buying all the way down to the 130s. Molina to me is just such a clear example of a disconnect between value and price. We've talked about the company and the risks before, so I'm not going to do a deep dive, but Molina, 75% of their premiums are for Medicaid, within the Medicaid segment, which, yes, is an extremely low margin segment of healthcare. I mean, we're talking 3-4% margins here. Within that segment, they have better margins than their peers. They're actually the high quality operator there if you're just looking at margins. And yes, as we know, this year, health costs have been under a ton of pressure, and they felt that across the board from Medicaid to the marketplace. Marketplace, while it is only 10% of their premiums, it is an enormous drag on their earnings this year. They're going to be losing a couple bucks in earnings per share on that marketplace segment alone just in the fourth quarter. In spite of this, in spite of all the troubles that they've had this year, Molina is trading for, roughly 10-ish times earnings for this year's earnings, this troubled year of earnings. They're trading for 10 times. They're still highly profitable, even losing massive amounts of money on marketplace and having margins be way lower across pretty much all of their segments. At the same time, they have a net cash position, which you can't say about many other companies in the space. Now, rates are going up across the board in pretty much every segment, and Molina is also pulling back from a lot of their marketplace plans. So I expect over the next couple rate cycles, 2026, 2027, that margins will recover. This happened before in 2017 to 2019, and it's what I think is going to happen again. And if that's what you believe, if you hold that thesis, then if Molina gets back to 4.5-ish% pre-tax margins, it's trading for roughly 5 times those future earnings. Again, while having a net cash position and being the better operator in its primary segment, which is Medicaid. My base case of 5% revenue growth on the top line over 5 years, margins getting back to 4%, which really isn't even quite a full recovery, and only giving them an 8 times multiple, I'm looking at more than a triple on this stock over 5 years. I think the risk reward here is excellent. And yes, the narrative is very poor. They focus on Medicaid. Medicaid eligibility will likely be under pressure in 2027, 2028. But I do not believe that Medicaid fundamentally is going anywhere in this country. Medicaid will continue to exist, and Molina will continue to be a profitable operator. That's my belief. And if you share that belief, then Molina today is extremely underpriced. Is this a broken stock? They're down more than 50% on the year. Over the past 5 years, they're still down about 30%. From their peak, Molina is down about 65%. They lost 2/3 of their value. You can call this a broken stock if you want, but to me, this is just business as usual in the stock market. Stuff like this happens. For all I know, Molina might continue to drop in price. This could continue going down. I'm not sure. I mean, especially towards the end of the year, where I imagine you're going to have increased selling pressure from tax loss harvesting. I wouldn't be surprised if this drops more. I have no ability to predict the bottom of a stock. What I do believe is that the risk reward is excellent. Molina is now a 3% position in my portfolio, and at these prices, I'm happy to add more and increase my holding in Molina. I know what I own, and even if the price goes down way more, I will still sleep fine at night. So just in conclusion, if you see a ton of volatility in the market, you see your portfolio dropping a bit in value, just know it's because of this volatility that we are able to make excellent long-term returns. We were entering Centene at $27 a share. We were entering UNH and Elevance in the 270s. And yes, now I am buying more of Molina. If you know what you own, you're not going to worry as much about the short-term volatility, and you're going to do fine in the long run. So with all that said, I hope you got value out of the video. If you did, subscribe to the channel. If you want to support what I do, or you want to make spreadsheets like the one I have here, then consider following me on Patreon. Link to that will be down below. If you agree or disagree with anything I said in this video, let me know why down in the comments, and I hope to see you all in another video.